welcome back to the second half of accounting. Last class, we were talking about ratios when we left. And so let's pick up with ratios. Chapter 13, we've gone through liquidity ratios, measuring basically the amount of current assets relative to current liabilities. And we have gone through the leverage idea. And leverage, a very important topic, particularly in finance, right? But leverage is measured through accounting numbers. And leverage, financial leverage, in this case, is primarily simply the amount of debt the company has. So when someone talks financial leverage, you now know they're really talking how much debt. And we'll go through an example or two later on, not this class, but in the future, where we get a better handle on what leverage means. Now, activity ratios. So, page 1 of chapter 13, activity ratios, we go back to our balance sheet, A equals L plus E. And activity ratios are going to measure what? They're going to measure how well we use our assets, in essence, right? And so activity ratios are a measure of efficiency. The first activity ratio, if we go to the computer screen, please, is the accounts receivable turnover, which simply is net credit sales divided by average accounts receivable. Higher is better, true or false? Do me a favor.
Yeah.
Close this a little bit.
Yes.
Higher is better, in general, on average.
Yes.
It's just probably true, right? Because as this number gets larger, right, assume receivables remain the same, as sales go up, that means we are having to finance a lesser amount of receivables relative to the amount of sales that are coming in. Does that make sense, everybody? However, what would be the problem if this were too high? If this ratio is too high, what could a problem be?
You may not be receiving your payments.
No. Because if you weren't receiving your payments, receivables would balloon, and that would cause the ratio to go down. Right? What was that?
She said policy.
It could be the case that your credit policy is excluding good customers simply because they don't appear to be low enough risk. And it may make sense to be willing to, or to be able to expand your credit policies, give credit to more customers, which would cause, which could cause receivables to go up. Okay. Age of receivables. Age of receivables is 360 divided by the accounts receivable turnover. Higher is better, true or false? Higher is better, true or false? And the answer is false, right? Because the higher the turn, the lower the amount. In other words, the question is, how long does it take us to get our cash, right? The age of receivables is how long does it take us to get our cash? And if it takes us, if you come to the pad, please, if it takes us 30 days on average to get our cash, right? Is that better or worse than, say, 45 days? And so, obviously, you'd rather get your cash in 30 days because you want your cash as soon as possible, right? So the age of receivable simply says, how long does it take us to get our cash? Inventory turnover. Next one. Inventory turnover. Inventory turnover, cost of goods sold divided by average inventory. How do we calculate average inventory? Beginning balance plus ending balance divided by 2, right? Simple average. So cost of goods sold divided by average inventory. Higher is better. True or false?
True.
The answer is true, right? What's a reasonable number for the inventory turn?
Depends on the business.
Depends on the business. What does GE strive for these days? 10, right? They strive for 10. Now that's a fairly aggressive number. Now why do you want a relatively high inventory turn?
Less warehousing costs, less inventory.
The whole goal is to have less in inventory, right? Because inventory is extremely expensive. Why is inventory expensive? If you come back to the pad for a second, please. Inventory is expensive because, if you come back to the pad, Brad, even though I know it's not Brad. So why is inventory expensive? One is because you have to borrow to create the inventory or to buy the inventory. So you have interest cost. The second thing is you have warehousing, which was mentioned. You also have, if you have inventory, you have to have somebody walking around with a gun to make sure stuff doesn't walk away by itself. Another reason is because sometimes these things just go bad, right? Sometimes the roof leaks, things get wet. So we have all these costs. Generally, the carrying cost of inventory is considered to be around 25 to 30% per year. So in other words, the higher inventory is, you incur an extra 25% just to keep that stuff in usable order. So what many firms have done, in fact most firms, they have focused on trying to reduce the amount of inventory, become more efficient with the amount they invest in inventory. And that's why the expected turn, in general, has gone up over time. Questions? Okay. Next, last ratio on the first page. Total asset turnover, which is net sales divided by average total assets. Higher is better, true or false? Higher is better. In general, on average, that's true, right? Because you want to have the lowest asset base you can possibly have to generate as much sales as possible. So as sales goes up relative to a constant asset base, you'd be more efficiently using your assets, therefore higher would be better. Again, is this making sense? Profitability. I'm on page 2. Profit margin, gross profit percentage, return on assets. Right? So the return on assets is simply, often it's net income divided by average assets, but sometimes it's net income add back interest expense divided by average total assets. And all we're doing is we're comparing how profitable a firm is. Return on equity. Net income minus preferred stock dividends divided by stockholders' equity. Well, now wait a second. What are preferred stock dividends? What is preferred stock? I guess would be a better way to start that question, right? What is preferred stock? Okay.
It's stock that I think it usually yields at a higher. Generally has a higher yield than the common stock, and I think it's more sheltered to risk.
Okay. If you come to the pad,
and dividends are paid first for preferred stockholders as opposed to common stockholders.
If we have debt on one side, you're exactly right. They get paid first. Whereas equity on the far side, preferred stock is a hybrid. It's a combination of debt and equity. Now, where debt has a required interest payment, equity has dividends, which there is no percentage. I mean, the dividends can be anything you want. Preferred stock is relatively more similar to debt in the fact that it has usually a stated dividend rate, say 8%. The same way you might have an 8% interest coupon payment, preferred stock would have an 8% dividend. However, preferred stock is like equity in that these dividends are not tax deductible. Dividends are like preferred stock is more like debt in the sense that usually you do not get a vote for management. Only common stockholders get to vote on the priority issues of the firm, generally speaking. So, again, this preferred stock thing is a hybrid In some ways it's like debt, in other ways it's like equity. But in any case, the preferred stockholders get paid their dividend in any year before equity holders get paid, their common stockholders get paid their dividends. So in this case, if we go back to the computer screen for a second, in order to get average stockholders' equity, any return going to preferred stockholders has to be subtracted out from net income because their payments would always be made before common stock payments would be made, which is why that gets subtracted out. Questions? Okay. Price-earnings ratio, the PE ratio. PE ratio is simply common stock price divided by earnings per share. Higher is better, true or false?
To a certain extent. Depends on how you go.
Okay, tough one to give a yes, tough one to agree or disagree with, right? The PE ratio, what does the PE ratio represent? Suppose the PE ratio is 20. What does that mean?
It's expectation. You would expect the company to grow at a pace about 20 times its earnings.
No.
Isn't that what they use to value a firm, whether it's under...
It's what they use to value a firm. That's true. What this means is that $1 of net income generates $20 of value in today's terms. As simple as that, right? So the PE ratio is 20, price divided by earnings per share. It means that $1 of net income generates $20 worth of value in terms of the common stock. Now, the interesting thing is that what Bill said is exactly right. The PE ratio will be reflective of expectations of the future. For instance, for a long time, Microsoft was trading at a PE ratio in the high 40s, even the 50s. That's not quite true today. However, the PE ratio for Microsoft at one time was much higher than similar companies, simply because the expectation that Microsoft will continue to have all these wonderful years drove the price up relative to the earnings, which caused a relatively high PE ratio. So, what you should understand here is that the PE ratio is one of the things that virtually every investor looks at. And if a firm's PE ratio has been in the 20 range and suddenly dips down to, say, 16, many investors will look at that and say that's a possible buying opportunity. Because as the PE ratio goes back up to what it more likely will be, what that means is the price will probably be coming up. Anyway, last ratio, the market price to book value ratio. So the last ratio, market to book. Well, first thing, the book value is what? How do we measure book value? We go back to our balance sheet. And our balance sheet is assets minus liability, assets equal liability plus equity, right? Book value is assets minus liability, or it's equal to equity. So in terms of accounting, the book value of a company is either assets minus liabilities, or, said differently, it's equal to the amount of equity, the amount of accounting equity. Now, the market value of a firm, how do we calculate the market value of a firm? We take the number of shares of common stock multiplied by the price per share, and that is the value of the company on the market. Now, if we compare the market value to the book value, and that number is less than 1, what are you thinking? Right? Many people will argue that the market guy, thank you very much, Microsoft's PE ratio 32, that many people will argue that in general, this ratio should be greater than 1, and if it in fact is less than 1, it's a buying opportunity for that particular stock. Particularly if this ratio historically and in general is above 1. Again, you need to look at both the time series and the cross-section kind of analysis. Questions? Okay, let's go to the first case. The first case, alchemy product. What's going on in this case? Who's read this case? Is this case worth doing? Okay, what's going on?
Basically, the bank who's providing a loan for the past 40 years for alchemy products is considering asking for repayment in full of the loan because of their financial history. Has been worse and worse and worse every year consistently.
Okay, so the financial structure, the ratios indicate things are not looking so good, right? And so the bankers are worried. Now,
and there's a clause in the contract that says that they actually can do this.
There's always a string in a contract saying that if your ratios fall below some number, we can call the loan. Now, I'm sure you were wonderfully amused by the fact that I calculated all the ratios for you. You can thank me for that later, and thank me in cash, okay, later, at a later date, for that particular thing. Now, I did that so you can spend your time analyzing rather than crunching numbers. So, let's do a little bit of analysis, right? So the question becomes, for this particular company, where are their problems, right? So we have liquidity issues, we have leverage issues, we have profitability issues, we have efficiency issues, right? The activity ratios, we have all these things, and the question is, where is this company having difficulty? So, if we look at the current ratio, and this is the current ratio, this is time, what is their current ratio doing? Decreasing. What is the industry average? So industry average looks like this. So what does this tell you? So the arrow represents the firm. The average is a horizontal line. What does that tell you?
Your liabilities are increasing.
So the current ratio is equal to what? Current assets divided by current liabilities, right? And what's happening is either the liabilities are going up relative to assets, right? Or assets are going down. But in any case, this ratio is going down. Now, is that good or is that bad?
Not good.
Not good, right? Not good. Okay. How about debt total assets? We look at debt total assets. This is the percent of debt. It's going up. What's the industry average? 50%. Do they have a leverage problem? Do they have a leverage problem?
Not compared to the rest of the industry.
Okay, you don't like the trend, perhaps, but do they have a problem right now? The answer is probably not, right? So do they have a liquidity problem? The answer is, yeah, probably. Do they have a leverage problem? The answer is probably not, at least not right now. That makes sense. Okay, how about inventory turnover? So if we look at the inventory turn, we look at it through time. So this is the inventory turn. And the inventory turn is going from 8.7 to 5.4, 3.5, doing one of these numbers right here, downward spiral. And the industry average is somewhere in the middle. What does that tell you? Okay, it tells you that inventory is doing what?
Going up.
Going up. Let's look at the balance sheet and see if our ratio analysis agrees with the numbers on the balance sheet. We look at inventory for 97, 98, 99. Go from 306 to 510 to 826. So in 2 years, it more than doubles. What does that tell you? Okay. What's in this firm's inventory? What does this firm make? Jewelry. What kind of jewelry? Costume jewelry. Right? Now, costume jewelry that's more than 6 months old. What's the sellability factor? Probably not very good, right? Because costume jewelry is fairly trendy. So if you see inventory ballooning and you're a banker, what are you thinking?
Bad investment.
They can't sell that crap, is what you're thinking. Right? Okay. Let's go back to our ratios.
Their account receivables are going up, so that means they must be selling.
Average collection period. Average collection period is doing what?
Going up.
So average collection's going up. Industry average is 32. What does that tell you?
The creditors are taking longer to pay.
Creditors are taking longer to pay, or they're
Credit terms are
not
stringent.
What's that?
Credit terms are not stringent.
Credit terms are fairly easy. But again, if you're a banker, what are you thinking?
They're not getting paid.
They're not getting their cash. So if you're a banker, what are you worried about?
I'm not going to get my cash.
You're worried that those receivables, in fact, are not bona fide receivables. Right? Okay. So we look at total asset turnover. Is there a problem with total asset turnover? The answer is
Yep.
maybe a little bit. They're a little bit inefficient. Profit margin on sales is going through the floor. Is that good? No. Return on assets. So this firm has a profitability problem, has a liquidity problem, and it seems to have both an inventory problem and a receivable problem. So, you're the banker.
Couldn't you also say because of the total asset turnover that's going down that they may be, I mean, and in this case, in terms of their building, their land and building, it's going up a lot compared to
look at their fixed asset turnover.
Yeah, it's not.
Fixed asset turnover is relatively stable, right? So where are they getting a balloon in assets? Not in fixed assets, but in current assets, right? And what are the two current assets that are ballooning? Inventory and receivables. Any questions so far? Dave?
You also mentioned in the case that the price of some of the metals and other raw materials are increasing.
Mm-hmm.
Does that contribute to the increase in the inventory?
Certainly could contribute to the increase in inventory. Right? Now, as an aside, I've done a lot of work around this area with small firms. And guess what problems I look for first every time I walk into a small firm? Inventory and accounts receivable. Virtually every small firm has problems with inventory and accounts receivable. Turns out firms hate to call up their customers and say, give me the cash. Nobody in the firm wants that job. Right? Everybody hates that job. Therefore, receivables lag. And so the first thing I always look at is who's doing it, how are they doing it, what's going on. The next thing I look at is how much inventory do you have? Why do you have that much? Can you go to a just-in-time system? How do we streamline, how do we reduce the amount of inventory? These are the classic problems in small business. So if you are thinking about starting your own firm and it's any kind of manufacturing, hopefully you're a little bit savvier right now. Now, so you're the banker. You have to make a decision. Are you going to continue to lend to this company? You're the banker. What are you going to do, Dave?
I would tell them to stop making things and sell some stuff.
Okay. Let's take that as a directive. So what are you going to tell them to do? Suppose you say, reduce inventory, sell some of that crap. Suppose you wanted to reduce it to the inventory average, to the industry average. How much cash would they generate if they reduce their inventory from where it is right now, the inventory turn, to the industry average? What's their inventory turn right now?
3.5.
3.5. What's the industry average? 7. So in order to get from 3.5 to 7, what would they have to do to inventory? Cut it by half, roughly. What's inventory right now? 826. So if they cut it by half, how much cash are they going to generate? 400. Let's rough it. Let's say 400,000, just to make it reasonable, right? Okay. Now, what's another thing that you're thinking about if you're a banker? Firm has all these receivables and they want your cash. So what are you going to ask them to do? Go collect them, right? So if you force this firm to get their receivables back in line, again, this is real rough, right? This is stuff we're doing ballpark, right? If their receivables, their average collection period is 49 right now, you get to go back to the industry average, which is about 32. What does that generate in cash? You cut receivables by about how much? By about a third. I mean, again, real rough, hopefully very intuitive, by about a third. So we look at receivables on the balance sheet, previous page. Receivables, 386, a third of that is 120, 130, somewhere in there. So if you're a banker and you look at these people, are you going to give them your money before you ask them to do something like this? And the answer is probably not, right? So what you're going to do is you're going to say, we will give you money if you need it, but there's a few strings attached. The first string is that you have to prove to me your inventory is sellable. Get rid of half of it. If it's sellable, even at cost, if you sell it at cost, it'll generate $400,000. Similarly, you have these receivables on the books. If in fact they're bona fide, then the amount of cash that should be able to come in is in approximately 120,000 range. So you get your balance sheet back in reasonable order, and then we will be happy to continue doing business with you. Does that make sense?
Would you also look at why they want that money? Because in this case, they want it to add to the plant.
They want to increase production to their production facilities, but if they're making stuff that no one buys, hard to believe it's going to solve any problems. So, I mean, as a banker, you need to get them thinking. You need to reorient the way they're thinking. Hopefully, bringing them into a cleaner view of what they're trying to do by forcing the issue, in essence. Phil,
you didn't mention the loan rate on here, did you? I don't see that. But wouldn't one option for the company be to issue bonds?
Well, this is a fairly small company. In order to issue bonds, you need to get to a national market, an international market, actually. Is it possible? Sure. Is it likely for a small company? And the answer is no. So most small companies end up either borrowing from banks or trying to raise money through equity. Questions?
How long would the bank typically get these guys to do this?
How long typically? Well, let's see. How long do you think it should take? Let's just use logic. How long should it take before some of the receivables should come in? What are typical credit terms?
A month.
About a month. right? I mean, the firm, in a month's time, the firm should be able to bring in 120 in cash just by getting receivables to a reasonable level, just by getting... Now, inventory, probably a little longer, right? Because you have to sell it and then you have to get the cash. So maybe 2 months for inventory.
You said that the jewelry is trendy, right? So what they have in stock may be harder to sell.
That's exactly right. But that's what, as a banker, you need to know, right? And that's the whole issue. Can they sell it? You don't know that. If you're a banker and you're not following this industry, you don't know that. And so before you're going to be willing to commit any more cash, you're going to want to know what you're going to want to make sure they can in fact sell this stuff. Now, it doesn't mean you have to sell everything, but they have to make a bona fide effort and show you that in fact what they have is sellable. Okay? Does that make sense? Questions? Okay. The next case we're going to save till next time because I want to move on to inventory for now. So this time, if you would look at the case for next time, we'll quickly go through the case of the unidentified industries for the next class. Questions? Okay. Moving on to Chapter 6, which is inventory. Before we go any further, any questions? Now, what you should be aware of in terms of the problem sets, right? Inventory questions generally appear in problem set number 2. So now that we are doing inventory, we are pushing to the next problem set. So the 3 problem sets that you should be working on, problem set number 1, which you should be able to work through, problem set number 5, which is present values, and now problem set number 2, which includes some material that was covered somewhat in problem set number 1, and inventory to some extent. Does that make sense? Okay. First of all, the basic model for inventory. If you go to the computer screen for a second, please. Our basic model, we purchase items, we capitalize those items into an asset called inventory, and then subsequently that asset becomes an expense on the income statement called cost of goods sold. Now, when do we recognize that expense again? When title passes, that's right. So, in terms of inventory, 2 basic types of inventory systems, very broadly defined. One's a perpetual system, the other's a periodic system. Now, in this class, we're going to deal almost completely with periodic systems because the algebra is much, much easier. But virtually every firm uses what type of inventory management system? Perpetual, right? In the age of computers, keeping track of inventory on a daily, hourly, even minute basis is a fairly easy thing to do. But in terms of the accounting for what we're doing, we're going to talk almost always about perpetual. Okay. Purchases become inventory when? When title passes. So it's not inventory for us until title passes to us. It's not cost of goods sold until when? Until title passes to our customer. What is included in inventory? Suppose you buy something. What of those costs are included? Obviously, the cost of the product itself is part of inventory. The shipping costs are part of the inventory. If you build the item, then any construction cost will be part of the cost of inventory. Things that do not get included in inventory include things like selling an administrative expense to sell the inventory or any kind of storage. These are separate line items, separate expense kind of items. Now the key thing here is that any of these costs, product costs, shipping costs, they get capitalized into the asset. That's key to understand. Now, what many firms try to do is they try to sneak shipping costs as an expense of the period. Why is that? And the reason is because when you convert that cost into an asset called inventory, you don't get the expense until down the road, therefore you don't get the tax benefit until down the road. So what many firms will try to do is they'll try to sneak shipping costs as an expense of the period so they get that tax deduction up front. Questions? Okay, in notes, example 6.1. And example 6.1, simply the purchase of inventory. So we have done this in the past. I'll go through it fairly quickly. So I'm on page 6.3. I will go through the gross method. So the basic information, we buy something for $5,000, terms 210 net 30. 10 days later, we take a discount on gross $4,000 worth of what we purchased. Subsequently, pay the rest. So the question is, what are the entries? Here we go. Entry number 1. We buy the stuff. We increase an asset called purchases. We could call that inventory, right? But the way Boylan does it so he can use his boxes, he calls it purchases. And we recognize that we owe someone the money for $5,000. Next, we take a discount. 2% of $4,000. 2 times 4 is $80. Therefore, we reduce accounts payable at $4,000. Recognize a purchase discount. A contra asset account reduces the amount of inventory for $80, and cash is at the door to the tune of $39.20. Lastly, we pay the last $1,000. Accounts payable goes down. We debit accounts payable. Cash goes down for $1,000. Questions? Fairly simple stuff. I'm on page 6.4. Inventory methods. We're going to learn 3 inventory methods in this class. The first method is the average cost method. And the average cost is just basically we're taking an average. And that average cost then gets used to value both cost of goods sold and ending inventory. So we take an average of what we have available. That cost then becomes the cost per unit for valuing both inventory and cost of goods sold. Now the second method that we need to understand is called first in, first out. And first in, first out is a situation where the items that came in first and their associated costs are the items that flow into cost of goods sold. So first in, first out refers to the costs that go into cost of goods sold as an expense for the period. Now, another valuation technique is called LIFO, or last in, first out. And for this particular method, the last items in are the first items in terms of the cost flow that get attributed to cost of goods sold. Now, the best way to understand how to do these inventory methods is to take a fairly simple example, which is what we have in the notes. Questions? Okay, in the notes. The basic information appears on page 6.5. And the basic information that we're going to be using for the next, for 3 inventory methods, right? LIFO, FIFO, weighted average. In year 1, we have a beginning balance of 80 units at 80 cents for a total cost of $64. In the first quarter, we buy 100 items at $1. Next, we buy 200 items at $1.10. 150 at $1.20. Quarter 4, we buy it at $1.30. So again, 80, $1, $1.10, $1.20, $1.30. Right? Nice progression, easy to remember. Notice here that when we add up the total amount of units that were purchased during the period, we get a total of 700 units. We add up the total cost of all those units, we get 825. What's the average cost per unit? How would we calculate that? 825 divided by 700, right? That would be our average cost per unit. So if we were doing the average inventory method, we would then value inventory and cost of goods sold at the average of what was purchased during the period. Does that make sense? Okay, so in year one we have purchases. We also have sales in year one. So you can leave me in the top right-hand corner. That was fine. In quarter one, we sell 150 units at a price of $2. Turns out the amount of dollars doesn't matter that much. The key thing is to track the number of units that get sold per quarter. So for the year, total sales were 750. Total value sales 1720. Questions? Okay. If we go to the notes, if you cut.
You get more money for your inventory, your turnover ratio is going to increase.
Not necessarily. So the question was, if I get more money for my inventory, does my turnover ratio increase?
Yes.
Right? The turnover ratio, if you come to the pad, please. The turnover ratio is equal to what?
Cost of goods sold over average inventory.
Okay. So now, if the sales price, if the price goes up, how does an increase in your sales price affect that ratio?
Increases cost of goods sold.
Why? Cost of goods sold is based on what? The cost to buy it or the cost to manufacture it, right? So the sales price does not affect the inventory turn, right? It affects profits, right? I mean, if the price goes up relative to the cost, profits would increase, which is a good thing, right? But inventory turn wouldn't be affected. Is that
okay?
Is that making sense?
It does. Sorry.
No, it's okay. Okay. So I'm going to go through the average cost method. In the notes, I'm on page 66. And what I have found is that this works fairly well if we think about this is the total amount available, right? Again, Boylan uses boxes. We have beginning balance plus purchases gives us cost of goods sold plus ending balance. Now, the first thing we have to do, no matter which method we are using, is we need to figure out what the units are. Because accounting has nothing to say about the units. Accounting has something to say about the value of those units, but not the actual flow. So in this case, beginning balance was how many? 80 units. What was purchased during the period? 700. What was sold during the period? 750. And therefore, what is in ending balance? 30. So before you can think about the value of anything, you have to make sure you know how many units you started with, how many units you purchased, how many units actually went out the door, and therefore how many units are left over at the end. Right? Now, before we think about the value of this, we first get the units right. Questions? Now, the first thing we would do the average inventory method. And the average inventory method, now we look at the dollar values of these things. And the dollar value of the 80 units that were in beginning inventory was how much? 84, right? 64. Just kidding. It's getting late, I'm getting tired. 64. The value of the 700 units was 825. We add all that stuff up, we get 889. We divide through by the number of units, which is how many? 780. And that gives us our average cost per unit, which turns out to be 1.1397. Does that make sense? Is there a problem or a question? Okay. Now we take this cost per unit and multiply it times the number of units that were sold and the number of units that were left, 1.1397. And that gives us the cost of the value we attach to cost of goods sold and the value we attach to ending balance. Questions about that? So in this case, $854.81 is the value of cost of goods sold, and 30 times $1.13 is $34.19. Notice that if we add up cost of goods sold plus ending balance, we need to end up with how much? $889. Does that make sense to everybody? So average inventory is a very easy process. It turns out all inventory methods are very easy processes. Very simple algebra. It's just understanding how to do it is the tricky part. Questions? Okay. So much for weighted average. Now, the firm we just did, is this a perpetual inventory method or a periodic inventory method? The example we just did. Periodic. It's periodic, right? Because we figured out one average cost for the whole year. If this were perpetual, what would be happening? You'd be updating your average. In this case, you'd be doing an average for each quarter. And you'd be recognizing cost of goods sold in each quarter at that average cost. Now, I'm not going to work through that example, but the algebra is fairly straightforward. It's just that there are more calculations. And that would appear on page 6-8 if it were a perpetual average cost method. But we're not going to go through that in class, and you will not see that from me in an exam. Okay, next, I'm on page 611. We'll talk about FIFO, first in, first out. So here we go back to the boxes. Beginning balance plus purchases is equal to cost of goods sold plus ending balance. Now, the best way to understand this is to think of everything in terms of layers. And the layers, the beginning balance is the first layer. This is 80 at 80 cents. Now the layers that were purchased, the layers are 100 at $1, and then 200 at $1.10, and then 150 at $1.20, and then 250 at $1.30. Now, the next question is, how do we do LIFO or FIFO? So we'll do FIFO first, which means the first ones in are the first ones out. Before we can do it, we have to go back and remember what are the units involved. Beginning balance was how many units? 80. Purchases were how many units? 700. Cost of goods sold, the number of units we sold was how many? 750. And the amount that was left over at the end? 30, right? So those units are what we are concerned about. Now, for FIFO, the basic idea is the 750 units that were sold, the first ones in are the first ones out. Therefore, the first one in was 80 at 80 cents per unit. The next one in from the first quarter was 100 at $1, then 200 at $1.10, then 150 at $1.20, and then since we have 30 left over, in cost of goods sold would go 220 at $1.30, and then the ending balance would be what? 30 units times what number? $1.30, right? For a total ending balance of, what's that, $39. Does that make sense, everybody? Now we know the total cost available was how much? $8.89. We calculated that earlier, right? And therefore, cost of goods sold has to be equal to what? $8.89 less 39 is $8.50. Now, another way to do that would be to do what? Would be to add up 80 at 80 cents, plus 100 at $1, plus 200 at $1.10, plus 150 at $1.20, plus 220 at $1.30, right? Well, I just kind of took a shortcut to get to cost of goods sold of $8.50. Does that make sense, everybody? Okay. Let's make a little chart of what we've learned so far, right? What we've learned so far. Let's go with cost of goods sold and ending inventory. And we have FIFO, we have average, and we have LIFO. Now, let's fill in some of these numbers from what we've done so far. FIFO, cost of goods sold, was how much? We just calculated at $8.50, right? And the inventory was how much? $39. When we did the average method, what was cost of goods sold? Go back in the notes. $854.81. And therefore ending inventory was how much? $34.19. So now let's do LIFO and see how they all compare, right? Because it turns out that if you're the CFO of a company, you get to choose which method you want to use. GAAP says you can use any one of these methods you want. So the question I'm going to ask you is, why would you choose one over another? Well, in order to make that decision, you have to understand what kind of results you're going to get depending upon which inventory method you use. Dave, you got a question?
Yeah, I was just wondering, can you switch from one to the other at any certain time?
Hold that question until later, okay? And the answer is you can switch, but you have to write a letter to the IRS explaining why you're switching inventory methods. It turns out to be a fairly onerous task. Okay. Now instead of doing FIFO, let's say we're doing LIFO. But we have the same purchases made during the period. So now LIFO, we have cost of goods sold plus ending balance. But if we use LIFO, what happens? The first layer in cost of goods sold is going to be what? The last layer in, right? The last layer in is the first one out, the first one to go to cost of goods sold. So if this is LIFO, the first layer in cost of goods sold is going to be $2.50 at $1.30. And then we're going to go down. What's the last layer going to be in cost of goods sold?
80 at 80 cents?
50 at 80 cents. Therefore, what's the ending balance going to be? We have 30 units at 80 cents. 3/8 are 24. So what is cost of goods sold? 865. Does that make sense to everybody? Okay, let's go back to our chart where we're comparing. So again, the calculations for LIFO, FIFO weighted average are extremely straightforward. You have to do a couple examples, and the notes have a couple examples for you to work through. But once you've worked through them, I think you'll find that the arithmetic here is very straightforward. There's no tricks going on whatsoever. The tricky part is, which method do you want to use? Right? That's the financial strategy, and that's what we want to talk about for about 5 minutes, and then we'll get out of here. Questions? So we fill in our chart, and we see here this is 865 is the cost of goods sold for LIFO, and 24 is the cost of inventory, or the balance of inventory. Now, notice what's happening. If you want to have a relatively low cost of goods sold, which method of inventory do you choose? FIFO, right? FIFO gives us the lowest cost of goods sold, and the lowest cost of goods sold gives us the highest earnings per share. True or false? True, right? The lowest expense gives the highest earnings per share. Everything else held constant, right?
This is assuming that prices are increasing.
Assuming that the cost of inventory is increasing. That's exactly right, and that's a very good point. In this case, the prices for inventory, the price we're paying for inventory, has been increasing, right? $1, $1.10, and in that case, FIFO will give you a relatively lower cost of goods sold. However, it's contingent upon prices going up. You're exactly right, Dave. However, so in a period of rising prices, and I'll put prices going up, these are inventory prices, FIFO does what? It maximizes what? Earnings per share. Does that make sense? However, suppose you wanted to maximize expense. Which method would you use?
LIFO.
You'd use LIFO, right? Why would you do that? Why would any firm maximize the expense? Because you decrease the amount that you pay to the government in taxes, right? Now, we're back, so this method here maximizes what? Cash flow. So if you're CFO at some company, here's your problem. You can only use one method for inventory. Whatever you use for your tax books, you must use the same inventory method for your GAAP books. Now, if you choose FIFO in a period of rising prices, which most companies are in, but not all, if you choose FIFO, earnings per share are going to be higher. Therefore, hopefully, stock price will be relatively higher. Does that make sense? However, since taxable income is going to be relatively higher, you're going to give more of your cash to the federal government and the state government. On the other hand, if you use LIFO, your expenses are going to be relatively higher, therefore you're going to give relatively less cash to the government. So you're maximizing cash flow. Does that make sense? And so the question then becomes, you're CFO, are you going to try to maximize earnings per share, or you're going to try to maximize cash flow? What are you going to do? Well, here's your question for next time. What do most firms do? What do most firms do with respect to inventory? Do they use FIFO or LIFO? Also notice here the two extremes. FIFO gives you the lowest cost of goods sold, LIFO gives you the highest, and average would be where? Somewhere in the middle, right? Because Average would be an average of LIFO and FIFO. Hopefully that makes sense. Questions?
They're not able to keep two different sets of books?
No. Whatever. See, the question that was asked earlier, you can use different depreciation methods, one for tax, one for GAAP, right? But for inventory, you must make a choice. Whichever method you use for GAAP, you must use that for tax. And therefore, from a financial strategy perspective, it's a very important decision. Because you have to decide, are you maximizing earnings per share, or are you maximizing cash flow? Right? One of those two things. Because you can't maximize both in general. And that becomes the age-old problem, right? What accounting policies do you use? How do you maximize value to our shareholders? By either maximizing cash flow or maximizing earnings per share. Because you can't do both at the same time. Last question.
Going back to that depreciation, what was that again?
Okay, we're going to do depreciation next time.
Okay, so
you're going to get an earful of makers and accelerated depreciation and all that crap, right? So let's postpone that question for 6 days. Okay, remember, class next week is on Monday again. You all have a great week. We'll see you next Monday.